China just increased their gold buying by 60% in the last quarter, and this is about to trigger a supply crisis that will directly impact India's gold market in ways most people don't understand. We're talking about the People's Bank of China adding 78 tons of gold to their reserves in just 90 days, the most aggressive accumulation we've seen since 2015. This isn't just about China stockpiling gold. This is about a fundamental shift in the global monetary system, and India is caught right in the middle of this geopolitical chess game. If you're in India, if you're planning to buy gold, or if you care about what's happening to your savings, the next 20 minutes will change how you see the precious metals market forever. Here's what they don't want you to know. Let me set the stage for what just happened in the last 48 hours, because the implications are massive, and the mainstream financial media is completely missing the real story. The People's Bank of China released their official gold reserve data 2 days ago, and the numbers are absolutely staggering. In the fourth quarter alone, China added 78 tons of gold to their official reserves. That's a 60% increase compared to their average quarterly purchases over the last 2 years. But here's where it gets interesting. That's just the official number. Industry analysts estimate that China's actual gold purchases, including off-market transactions and purchases through state-owned banks that don't get reported, could be 2 to 3 times higher. We could be looking at 200 tons or more of Chinese gold buying in a single quarter. Now, why does this matter to India? India is the world's second largest gold consumer after China, importing roughly 700 to 800 tons of gold annually. Indians buy gold for weddings, for festivals, for savings, and as a hedge against rupee devaluation. The Indian gold market is absolutely massive. But here's the problem. When China dramatically increases their gold buying, it creates a supply squeeze in the global market. There's only about 4,500 tons of gold mined globally each year. And when one major buyer suddenly increases their purchases by 60%, it disrupts the entire supply chain. This means higher prices, longer delivery times, and increased premiums for physical gold in India. In the last 72 hours, we've already seen the impact. Gold prices in India have spiked to 63,500 rupees per 10 grams, which is a new all-time high. But more importantly, the premiums that Indian dealers are charging over the international spot price have widened significantly. Normally, Indian gold trades at a premium of about $50 to $100 per ounce over London spot prices. Right now, that premium is at $220 per ounce. That's the highest premium we've seen since the import duty hikes in 2013. This tells us there's a physical shortage developing in the Indian market, and China's aggressive buying is a major driver of that shortage. Let me break down the mechanics of what's actually happening here, because understanding the supply chain dynamics is critical to understanding where prices are headed next. Look at this chart of China's official gold reserves over the last decade. For years, China was adding gold at a very steady, predictable pace, about 10 to 15 tons per quarter, very methodical, very controlled. But starting in November of last year, we saw a dramatic acceleration. November, December, and January saw purchases of 23, 27, and 28 tons respectively. That's 78 tons in 3 months. This isn't random. This is a coordinated strategic decision at the highest levels of the Chinese government. When a country increases their gold reserves this aggressively, it's sending a signal about their view of the global monetary system and their confidence in the US dollar. Here's what they don't want you to know. China has been systematically preparing for a post-dollar world for the last 15 years. They've been building the infrastructure for gold-backed trade settlement through the Shanghai Gold Exchange. They've been encouraging their citizens to buy gold through the state-owned banks. They've been investing in gold mining operations across Africa, South America, and Central Asia. And now, they're accelerating their official reserve accumulation. This is a country that holds over $3 trillion in foreign exchange reserves, preparing for a scenario where the dollar loses its status as the global reserve currency, and gold is their insurance policy. Now let's talk about the impact on global supply, because this is where India gets squeezed. The total amount of gold available for investment and jewelry demand globally is roughly 4,000 tons per year after you subtract industrial use and central bank buying from total mine production. India typically consumes about 800 tons of that 4,000. China consumes about 1,000 tons. Together, India and China account for nearly half of global gold demand. When China increases their buying by even 100 tons, that's a 2.5% reduction in available global supply. Basic economics tells you what happens next. Prices rise until demand is rationed. Look at India's gold import data for the last 6 months. We were averaging 50 to 60 tons per month through most of last year, but in December and January, Imports spiked to 85 and 92 tons, respectively. Why? Because Indian dealers saw what was coming. They saw China accelerating their purchases, they saw the premiums starting to widen in Asian markets, and they front-loaded their imports to secure supply before prices spiked even higher. This is classic supply chain behavior when there's fear of shortage. Buy now, even at higher prices, because you know prices will be even higher in 3 months. Now let me connect this to what's happening on the COMEX, because the paper gold market is showing severe stress signals that confirm the physical shortage narrative. The COMEX gold registered inventory, which is gold available for physical delivery, has dropped to 9.2 million ounces. That's the lowest level we've seen in 18 months. At the same time, open interest in gold futures has been climbing, which means more paper claims on physical gold, while the amount of actual gold available for delivery is shrinking. This is the exact same setup we saw in the silver market, and we know how that story is playing out. When you have a disconnect between paper claims and physical availability, the paper market eventually breaks, and price discovery moves to the physical market where premiums explode. Here's the critical data point that proves a supply crisis is developing. The Shanghai Gold Exchange Premium, which is the difference between gold prices in Shanghai versus London, has been persistently positive for the last 6 months. Right now, gold in Shanghai is trading at a $12 per ounce premium to London. That means Chinese buyers are willing to pay $12 more per ounce to get physical gold delivered in China rather than buying paper gold in London. This is physical gold flowing from west to east, and that flow is accelerating. When the premium is positive and widening, it tells you there's strong physical demand in Asia that's overwhelming available supply. Let's talk about the geopolitical implications, because this is about more than just supply and demand. This is about China positioning itself for a new monetary order. China is now the world's largest gold producer, mining approximately 370 tons per year. They're also the largest importer, bringing in over 1,000 tons annually, and they're the largest holder of gold among their citizens, with Chinese households estimated to hold over 4,000 tons of private gold holdings. China controls the gold market in a way no other country does, and they're using that control to reduce their dependence on the dollar and to build a parallel financial system based on gold-backed trade. Here's how this affects India specifically. India and China compete for the same pool of global gold supply. When China increases their buying, it directly reduces the amount of gold available for Indian imports. But there's a deeper issue. India runs a massive current account deficit, meaning they import far more than they export. Gold imports are one of the largest contributors to that deficit. When gold prices rise because of Chinese buying, India's import bill increases, which puts pressure on the rupee. A weaker rupee makes imported gold even more expensive for Indian buyers. It's a vicious cycle. Chinese buying drives up gold prices, which increases India's import costs, which weakens the rupee, which makes gold even more expensive in rupee terms. The Reserve Bank of India is watching this situation very carefully. In the past, when gold imports spiked and put pressure on the current account, the Indian government responded by raising import duties on gold. They did this in 2012 and 2013, increasing duties from 2% to 10%. That killed demand temporarily, but it also created a massive black market for gold smuggling. If Chinese buying continues at this pace and Indian gold imports stay elevated, we could see the government intervene again with higher duties or import restrictions, and that would send premiums in the domestic Indian gold market absolutely parabolic. All right, let's get into the technical analysis, because traders and investors need to know the key levels and what the charts are telling us about where gold is heading next. Looking at gold in US dollar terms on the daily chart, we're currently trading at $2,078 per ounce. We broke through the psychological $2,000 level with conviction 3 weeks ago, and we've been consolidating between 2,040 and 2,090 since then. This is a healthy consolidation after the rally from $1,900. The key support level is at $2,000 even. That's now major support, and it's held on 2 tests in the last 10 days. As long as we stay above 2,000, the trend is bullish, and we're setting up for the next leg higher. The next major resistance is at $2,100. That's the high from December, and it's also a major Fibonacci resistance level. If we break through 2,100 with volume, we're going to see a rush to 2,200 very quickly. There's very little resistance between 2,100 and 2,200 because we haven't traded in that range since 2012. The RSI on the daily chart is at 61, which means we're in bullish territory but not overbought yet. We have room to run higher without triggering technical selling. The MACD is showing strong bullish momentum with the histogram expanding, which typically precedes a continuation move higher. Now let's look at gold in Indian rupee terms because this is what actually matters if you're buying gold in India. Gold is currently at 63,500 rupees per 10 grams. We've been in a strong uptrend since October, making higher highs and higher lows consistently. The key support level is at 61,000 rupees. That level has acted as support twice in the last month, and as long as we hold above 61,000, the uptrend remains intact. The next resistance level is at 65,000 rupees per 10 grams. That's a psychological level and also the previous all-time high from 2020. If we break through 65,000, there's no historical resistance above that level, which means we're in price discovery mode. We could easily see 70,000 rupees per 10 grams within 60 days if Chinese buying continues at this pace. The volume analysis on the rupee gold chart is showing aggressive accumulation. We're seeing higher volume on up days and lighter volume on pullbacks. That's classic bull market behavior. Smart money is buying every dip. The Indian gold ETFs are seeing record inflows, which tells us that sophisticated investors understand what's happening and are positioning accordingly. The correlation between Chinese gold buying and Indian gold prices is extremely strong. Every time China announces a significant increase in their official reserves, we see a corresponding spike in Indian gold prices within 2 to 3 weeks. Based on the current data, with China buying 78 tons in the last quarter, we should expect Indian gold prices to test 66 to 68,000 rupees per 10 grams within the next 30 days. If China continues buying at this elevated pace, which I believe they will, we could see 75,000 rupees by the end of the second quarter. The rupee-dollar exchange rate is also critical to watch. We're currently at around 83 rupees per dollar, and the rupee has been weakening gradually. If the rupee breaks above 85 per dollar, which is likely given India's current account pressures, that will add another layer of upward pressure on rupee gold prices. You could have a scenario where gold in dollar terms stays flat at $2,000, but gold in rupee terms rallies simply because of currency weakness. This is the dual challenge Indian gold buyers face. They're fighting both rising international gold prices and a weakening domestic currency. So where is this headed? Let me give you my specific predictions and timeline because I want to be accountable to these forecasts. Short term, over the next 30 days, I expect gold to break $2,100 per ounce in international markets. The Chinese buying is relentless, and we're heading into the Indian wedding season in April and May, which is traditionally a period of very high gold demand. When you combine Chinese central bank buying with Indian seasonal demand, we have a perfect storm for higher prices. In rupee terms, I expect gold to test 66,000 to 68,000 rupees per 10 grams within the next month. The premiums in the Indian market will likely widen further, potentially reaching $250 to $300 per ounce over spot. Medium term, looking out 60 to 90 days, I think we're going to $2,200 in international markets. Here's why. China is not going to slow down their gold buying. They're in the middle of a strategic repositioning away from dollar assets and into hard assets, particularly gold. They understand that the U.S. is weaponizing the dollar through sanctions, and they want to reduce their vulnerability. As long as geopolitical tensions remain high, which they will, China will continue aggressive gold accumulation. For India, this means we're looking at 70 to 75,000 rupees per 10 grams by the end of May. Long term, over the next 12 months, I believe we're going to see gold challenge $2,500 per ounce. The factors driving this are structural, not cyclical. We have persistent inflation globally. We have massive government debt levels that can only be managed through currency devaluation, and we have a shift away from dollar hegemony led by China and other BRICS nations. Gold is remonetizing as countries diversify away from dollar reserves. For Indian buyers, this means gold at 85,000 to 90,000 rupees per 10 grams by early next year. I know that sounds shocking, but if you understand the macro forces at play, it's not only possible, it's probable. Look, here's the bottom line. China's 60% increase in gold buying is not a temporary spike. This is a strategic shift that signals their long-term view on the dollar and the global monetary system. India is directly impacted because we compete with China for the same global gold supply. Higher Chinese demand means higher prices for Indian buyers, wider premiums, and potential government intervention through higher import duties. If you're planning to buy gold in India, waiting for lower prices is probably a mistake. The trend is clear, the fundamentals are strong, and the geopolitical backdrop supports much higher gold prices ahead. If you found this analysis valuable, if this gave you a new perspective on what's happening in the gold market, I need you to smash that like button right now. It helps this content reach more people who need to understand these critical market dynamics. And here's what I want to know from you. Do you think Chinese gold buying will continue at this pace? How high do you think gold prices in India will go in the next 6 months? What's your prediction for gold at 65,000, 70,000, or even higher? Drop your predictions and your analysis in the comments below. I read every single comment and I'll respond to the most insightful ones. If you're not already subscribed to this channel, what are you waiting for? Hit that subscribe button and turn on notifications right now, because these markets are moving fast and you need to stay ahead of the curve. The China-India gold dynamic is just heating up, and the price moves we're going to see in the coming months will be historic. You want to be informed before the mainstream media catches up to this story. I'll see you in the next one. Stay sharp, stay informed.